Silver has returned close to the $90 level, and that alone says a lot about the current market situation. Just a few weeks ago, near the end of January, the silver market experienced one of the most intense corrections seen in decades after a sudden increase in futures margin requirements triggered a wave of forced liquidations across highly leveraged positions. In a single trading session, silver plunged by roughly 30%, marking one of the most dramatic one-day declines since the extreme volatility of the late 1970s silver market. During that collapse, weak hands exited quickly while traders using heavy leverage were pushed out of their positions. Financial headlines across major media outlets rapidly declared that the silver rally had come to an end. Yet today, prices have climbed back toward the $90 range. This raises an important question that this video will explore. Did the futures-driven sell-off actually accomplish its goal? And if it did not, what might that mean for the next phase of the silver market? My name is John A.G., and in this video we will walk through the data carefully. To understand the situation properly, it is important to be precise about what actually happened at the end of January, because many commentators either exaggerate the story or ignore the market mechanics behind the move. Before the crash occurred, silver had already experienced a massive rally. Prices climbed from roughly the low 70s in late 2025 to well above $100 at the peak of the rally. That represented a huge move in a very short period of time. Much of that rally was fueled by leveraged exposure through futures contracts, exchange-traded funds, and a rapid influx of speculative capital entering the trade. Whenever a market rises that quickly while leverage is involved, even a relatively small adjustment in margin requirements can trigger a chain reaction. Margin increases in precious metals. Markets are not theoretical events. There's clear historical precedent showing how futures markets can be influenced by trading behavior. For example, in 2020, JP Morgan agreed to pay approximately $920 million to resolve investigations by the United States government regarding spoofing and manipulation in precious metals futures markets. That settlement is part of the public record and widely documented. The key point is that futures markets operate on leverage. When exchanges increase margin requirements, traders holding leveraged positions must either add more capital or close those positions. Many smaller traders cannot add funds quickly enough, which forces liquidation. At the end of January, CME Group raised margin requirements on silver futures contracts because volatility had become extremely high. While margin increases during turbulent markets are not unusual, the timing occurred when speculative positioning was already stretched. The result was a rapid cascade. Within hours, prices that had been trading near the rally highs dropped sharply as leveraged long positions were forced to exit. Events like this are often described as futures-driven paper sell-offs, meaning the decline is largely triggered by derivatives market mechanics, rather than a sudden shift in physical supply or demand. However, the more important part of the story is what happened after the crash. A successful futures-driven reset usually does two things. First, it breaks the price momentum. Second, it reduces physical demand on delivery exchanges, such as COMEX, because traders stop demanding metal and instead roll contracts forward or settle in cash. Historically, only a small percentage of futures contracts ever result in physical delivery, since most traders close or roll their positions before delivery begins. That is how the futures market normally functions. But recent exchange data suggests something unusual has occurred. Physical demand has remained remarkably strong even after the January sell-off. Reports from COMEX delivery notices in early 2026 show that physical silver deliveries have remained elevated compared with historical averages. Several delivery cycles have seen tens of millions of ounces move through the system, which is significantly higher than typical months in previous years. At the same time, registered inventory levels on COMEX have declined compared with the large stockpiles that existed several years ago. During the early pandemic period, registered silver inventories were well above 200 million ounces. Recent exchange reports show considerably lower registered inventories today. In simple terms, the amount of physical metal inside the exchange vault system has been trending downward while delivery demand has remained relatively strong. That combination is one reason the silver market has stayed resilient even after the large January sell-off. To understand why this matters, it is necessary to examine the broader supply and demand picture. According to the Silver Institute, the global silver market has experienced several consecutive years in which total demand exceeded the combined supply from newly mined silver and recycling. Industrial demand has played a major role in that imbalance, as expansion in solar energy, electronics manufacturing, and electrification technologies continues to increase the need for silver. Silver is not only a monetary metal used by investors, it is also a critical industrial material. Solar panels, electric vehicles, advanced electronics, and certain artificial intelligence and hardware manufacturing processes all require silver because of its unique electrical conductivity. When industrial demand rises while mining supply struggles to expand quickly, The market can tighten even if futures markets experience short-term volatility. There are also signs of pressure within the mining sector. Several major primary silver producers have recently adjusted production guidance because of operational challenges, rising costs, and declining ore grades in some regions. When large producers revise output expectations, it can tighten future supply projections. At the same time, warehouse inventory reports from major trading hubs such as COMEX and several Asian exchanges have shown periods where stored silver stocks declined. None of this guarantees a specific price target, but it does show that the physical market has remained surprisingly strong relative to the volatility seen in futures trading. Naturally, this leads to the question many people want answered. Is $100 silver the next stop? The honest answer is that no one can guarantee any specific price level in commodity markets. Anyone promising guaranteed targets is either speculating or trying to sell something. What we can do instead is examine the conditions that would support higher prices. For silver to fall back toward the $70 range and stay there for an extended period, at least one major factor would likely need to change. Industrial demand would need to weaken significantly, perhaps because of a global economic slowdown. Mine supply would need to expand faster than expected, or physical delivery demand in futures markets would need to decline sharply, reducing pressure on exchange inventories. At the moment, none of those conditions clearly appear in the available data. Instead, the market appears to be stabilizing after what was essentially a leverage-driven correction. From a technical perspective, one key resistance zone that many traders are watching sits roughly between $93 and $95. Silver has tested that area before, and a sustained breakout above that region could open the door for another upward move. However, markets rarely move in straight lines. The more important shift may actually be structural rather than purely technical. The early phase of the rally was heavily driven by speculative momentum and leveraged positioning, whereas the period following the correction appears to be supported more by physical demand and long-term supply concerns. A market supported by physical demand tends to be more stable than one driven purely by speculation. So what does this mean depending on the type of silver exposure you hold? If you hold physical silver, the volatility of the futures market does not change the fact that physical demand has remained strong. Investors who accumulated metal during the panic selling period are now sitting on significant gains as prices recovered. If you hold PSLV, that product represents allocated physical silver stored in Canadian vaults under the supervision of the Royal Canadian Mint. During periods when delivery demand rises in futures markets, some investors prefer fully allocated structures because they remove certain layers of counterparty complexity. If you hold SLV, the ETF stores silver through a custodial structure managed by BlackRock with large institutional vaulting partners. Under normal market conditions, the product attracts silver prices efficiently, but investors should always understand the structure of any financial instrument they hold. If your exposure comes through AGQ, which is a 2x leveraged silver ETF, volatility becomes extremely important. Leveraged ETFs reset daily, meaning sharp declines, followed by rebounds, can erode returns through volatility decay. For that reason, they are generally more suitable for short-term trading rather than long-term holding. And if you hold silver mining stocks, the situation becomes even more complex. Mining companies usually produce silver at costs significantly lower than the current market price. When silver prices rise, profit margins for these companies can expand quickly. However, mining companies also face rising energy costs, labor expenses, and operational risks that can influence profitability. Because of this, mining stocks often behave differently from the metal itself. Looking ahead over the next several weeks, one of the most important data points for silver investors to watch closely is exchange inventory data. COMEX regularly publishes reports on registered silver inventories as well as delivery notices. If inventories continue trending downward while delivery demand remains elevated, it reinforces the narrative that the physical silver market is tightening. Data like this often acts as a leading indicator before mainstream financial media begins reporting on the trend. So where does the market stand right now? Silver has rebounded strongly after experiencing one of the most aggressive corrections in decades. The futures-driven liquidation event removed a large amount of speculative leverage from the market, yet physical demand indicators, delivery data, and long-term supply trends still appear relatively strong. Does that guarantee $100 silver? No, but the structural conditions that could support higher prices still appear to be present. I will continue tracking COMEX inventory data and delivery activity through the upcoming delivery cycles. If you want updates when new data becomes available, the link to join is in the description below. If you found this analysis useful, consider subscribing. I regularly publish data-focused breakdowns of the silver market that concentrate on verified information rather than hype or guaranteed predictions. And before we finish, one question for the comments. What type of silver exposure are you holding right now? Physical metal, PSLV, SLV, leveraged ETFs, or mining stocks? And did the January sell-off change your strategy at all? Let me know in the comments below. I read every comment.